In his speech to the joint session of the National Assembly on the 2024 budget, Nigeria's President Bola Ahmed Tinubu says, and I quote, he's confident that his government's proposed budgetary allocations and directives will set Nigeria on a transformative path towards a sustainable and resilient energy future, fostering economic growth, job creation, and environmental preservation, end of quote. We, of course, all want him to succeed, but we also need to take a closer look at the details. Under his proposals, Nigeria will spend at least 6 times more on servicing its debt next year than on building new schools or hospitals in the West African country. Of course, the largest economy in Africa, with almost 30% of the budget going to debt service alone. Spending on education will consume 7.9% of the budget, while healthcare will get 5% and infrastructure a similar amount. To tackle this, the government has set an ambitious revenue target of 18.3 trillion naira for 2024, which, if achieved, will bring down debt service costs to 45% of projected revenue, compared with 98% this year, 2023. And also that would help narrow the budget deficit. Well, to help me dissect this further and also shed light on Nigeria's current growth trajectory and other economic indicators, including how we're likely to end this year, is Chinwe Egwim, Chief Economist at Coronation Merchant Bank and Head of Economic Research and Intelligence. Great to have you back on the show with me this morning, Chinwe. Good to see you.
Thanks.
The government has kept economists busy, right? I guess all those research papers have been going out, but we'll start with GDP figures.
Okay.
A marginal improvement on the previous quarter.
Yes.
I mean, I think it's a marginal improvement, but given where we are, many people were quite excited that it wasn't all doom and gloom. So tell us what this means.
Well, as you said, marginal, so slight improvement, but it's still very much sluggish, right? And that wasn't surprising. To be very honest, I do understand sentiments around the excitement that you just mentioned, because a handful of analysts did expect to see contractions among specific sectors, especially manufacturing, given the transmission effect of the FX depreciation that really does impact or should impact the manufacturing sector. But yeah, it's a slight improvement, and consumption patterns are still very much weak. And why is that important? Because consumption triggers or stimulates demand, and you need that for, proper economic activities. Now, for this quarter that we are currently in, that's the final quarter of the year, the projection is really just below 3%, so about 2.9%. And that little boost is really coming from the, seasonal demand boost that we see
in December.
November and December, so the prep into the festive season. We do expect to see a slight improvement with production levels in the final quarter of this year. Fluctuations as well in oil prices. Oil prices have been above $80 per barrel. Again, that transmission effect with regards to exchange rate dynamics would have an impact. And when I say impact, not in a positive way. Consumption patterns. Inflation figures are still elevated, and this is squeezing pockets.
Yeah.
So
we'll come to inflation in a short while, but I wanted us to talk a bit about the specific sectors, because this is a trend we've been seeing, right? And this is what concerns me. Agriculture remains a poor performer. This is despite the fact that we know that about 90% of employment
comes from there.
And it's a poor performer. 90% of employment comes from there. You can start to see where we have challenges, right? There's a productivity issue, but services is still leading the way.
Yes.
And this has kind of been a trend. And I'm thinking to myself, structurally, there's something clearly wrong.
Yes.
If the biggest employer of labor is performing poorly from a growth perspective, it not only means that there's low productivity, but it also means that the economic livelihoods of those who are employed in that sector are also significantly impacted. So how are we going to pull ourselves up in the agricultural space?
Okay, so I'll just say something from a statistical point of view. Let me highlight that when we look at how much agriculture contributes to total GDP, it is way more than these other sectors.
Yes.
So I'm not saying that they're coming from a low base, but when we compare to agriculture, their base is lower. And so they have the tendency to spike with regards to their growth rate. So I'll just put that out there.
Good point.
Yes. But with regards to services, the key drivers have really been ICT. And then finance and insurance, right? At some point, transport and storage was in that category, but like we've seen it contract twice now. Yeah. Very visible contractions, by the way.
And of course, that would impact inflation ultimately because it's tied to logistics.
Yes, exactly. Yes, so supply chain disruptions as well. But there are different reasons that one could attach to that contraction, and one of them would be the FX depreciation. One could argue that it's now more expensive to bring in imported spare parts, right? So that is also impacting, and then a host of other reasons. But let's go back to agriculture. Yes, agriculture is underperforming at 1.3%, but remember we did see a contraction in that sector. Yeah, we did see a contraction in that sector. So I'm hoping that as time goes by, so that will be sometime next year, that we would see it go back to its 3 to 4.5% range. But ideally, an average of 5% should be the minimum for a sector like agriculture. Yeah. You did say it, that it's the biggest employer, especially in the informal sector. So an average of 5% year on year is required. But like for this national accounts that were released, Q3, the key driver was still crop production, as always.
Crop production,
yes.
Yeah. Yield per hectare obviously has been impacted.
Exactly. Fisheries and livestock came in a bit sluggish. But yeah, like the things that we've been saying for years, security issues. There are also issues with FX as well. So imported inputs that help farmers as well has been impacted. What else? Logistics. Yeah, like for perishables, you still have issues where some of the harvested products that could get rotten, half of them would get rotten before they move from, let's say, the northern area or the food basket down to the markets in the south. So these things these are structural issues that need to be
and of course, agriculture as a sector is also quite vulnerable to global shocks because of the dependency of the inputs.
Yes,
as you mentioned. So, okay, moving away from services and agriculture, let's talk about some of the other sectors that could really play a significant share in GDP. And let's even leave oil aside. let's focus on some of the other interesting sectors that you think should be in a much better position than they are now. Where would you be, I guess, if you were betting on them, where would you be placing your money?
So, so there's something we do in my team. We do this in-depth analysis where we categorize sectors into resilient, unstable, and then contraction sectors. And I would say that the sectors that are in resilience should remain there. Again, it's really effective policy implementation that would allow for this growth boost or spout that one expects to happen. I would put agriculture in that category. Okay. I will put manufacturing. I would like to see manufacturing or specific segments under manufacturing. Let me not just give manufacturing. It's wide. It's about 13 segments in there. So the segment that does cover food and beverages, the segment that covers clothing, apparels, footwear, cement is in there as well, the pharmaceuticals and so on. So I would expect to see, because of the policy recommendations that are going out and expectations around policy implementation, I would expect to see some good momentum happening within those segments in manufacturing. Now for trade is really a good barometer, with regards to demand. So that would really be heavily dependent on consumption patterns. But trade is one sector that does give some kind of boost to the overall GDP output. So I think I would expect to see it as one of those sectors. But you know how we have quarters. So 4 quarters in a year, it might not feature in every quarter, but I expect it to feature in at least 2 quarters next year. What else? Finance and insurance. It's been doing really well, double-digit growth for the past at least 4 quarters, and I expect to see that trend continue. You know what? The NBS is supposed to be rebasing the national accounts. I know that they did give a date at some point, which has passed. So I do look forward to seeing rebasing activities. If we see that, we would see, or I expect to see, more sectors. I would like to see segments within the orange economy, be highlighted as well, and some sectors that some of us feel are not being properly captured.
For the purposes of our viewers, the orange economy being
the creative industry.
I know the blue economy, marine, the oceans, things like the orange, the creative economy. All right. So, interesting question for you as an economist. There's always a time lag effect of policies, right, to actually then impact the indicators. What is the typical time? So if we're talking about these sectors and the policy interventions, if you focus heavily on your policy interventions in the third and fourth quarters of 2023. When can you start to expect to see the results of those interventions?
Okay, this is my opinion. I would say Q2, and that is if it's effective
Q2
of the following year. And that is, we have implementation, but it must be effective.
Right.
You know, proper monitoring and evaluation.
So the quality of that implementation.
Yes,
right.
yes. So I would take Q2.
Okay, that's interesting. Okay, so we talked quite a bit about GDP now. I wanted us to maybe segue a bit into the budget story because, frankly, they're all intertwined. Actually, part of the budget GDP projections is that 2024, 3.76% in that year. That's what the government is projecting. Of course, we know about the broader ambition, which is the $1 trillion economy that President Tinubu has said. Do these projections align with what your team at Coronation Bank, Merchant Bank, and other analysts are projecting? Far off or pretty much around market projections?
These are the benchmarks you're referring to. For the growth rate, I think it's achievable. That is 3.76%. Again, it's really largely dependent on effective policy implementation, as I've said earlier. So it is achievable. When we look at, you spoke about the $1 trillion economy target, and I believe that timeline is 7 years.
Yes.
Yes. So in my opinion, it's achievable because when we look at full year 2022, dollar terms, it is about 477.
Okay, so we're almost halfway.
Halfway. Thank you. So if that push, the required push is if we see it, it is possible for us to get there within 7 years. Again, effective implementation.
Yeah.
But yeah, with regards to other benchmarks, the oil price, it is conservative. I think our average is about $88 per barrel by end of 2024.
Okay.
But of course, that's a market that is so volatile. You know this.
Extremely volatile.
So a lower price is obtainable given the volatility of that market. For the exchange rate, I believe is 750. Yes. Well, again, that is a demand and supply dynamic with regards to liquidity, right? And if specific targets which they've put in place do come to pass, I believe that rate is feasible. For us, and this is on the NAFAM. This is on the NAFAM. A rate at about 785. Naira per USD at the end of next year is feasible.
Okay.
And this is, of course, there are different factors that are influencing this forecast. So yeah, production.
Oil production, 1.78 million barrels a day.
Yes, okay, and I'm assuming that condensates are in there. If that is the case, then yes, I believe it's achievable. But from my vantage point, I'll put it at a range of between 1.4 to 1.6.
Yeah. See, OPEC has come out to ask Angola and Nigeria to cut back even more because OPEC is on its own end trying to influence global oil prices. In a way, we also want good, robust oil prices because they help our revenues. Yes. But at the same time, we don't want to cut back on our production, right?
Yes,
so how is Nigeria going to navigate all this?
That? Yeah. But I think there's an ongoing debate. So let's see how it goes. Yeah.
Interesting. So let's talk about the budget deficit and some other parts of this. 9.18 trillion in 2020, or 3.8% of GDP. Lower than what we recorded this year. So clearly a lot of positive sentiment, but more importantly is the debt, national debt and debt sustainability. Can you perhaps comment a bit on Nigeria's debt sustainability heading into 2024? Yeah.
Okay, well, several factors do contribute to debt sustainability, including the country's debt to GDP ratio, debt service to revenue ratio as well, and of course the structure of the debt. Is it concessional? Is it commercial? From my vantage point, I do believe that borrowing is going to be heavily domestic.
Yes.
External borrowing from a Eurobond perspective, I don't see that in the near term. And this is not just...
Why is it because of investor sentiment?
Well, not just investor sentiment, even just what we're seeing globally, like interest rates, global interest rates as well. So yeah, and of course investor sentiment. I don't see that happening at least in the first quarter of next year. But again, as everything is dynamic, so it's like a wait and see approach. Now, the ratio for the debt to GDP, when we do the calculations and the estimates against the estimate of total GDP in the budget, is above the threshold of 3%. But I do understand that there are plans or ongoing discussions around, adjusting that threshold. So I think for me, what I'll just say is, you need to borrow as a country. That is a given. But being cautious. A cautious approach is required, and the borrowings really should translate into. It should be effective borrowing. You know, for a long time, it's been borrowing for recurring expenditure. So it would be nice to see the borrowings channeled into capital projects that would help with closing that infrastructure gap, and the ripple effect of that will be to boost revenue for the country.
Of course, and speaking of revenue collection obviously has seen an increase in the 9 months to September. So that's been positive.
Yes.
I wondered whether you had any thoughts on what may have accounted for that.
From the non-oil perspective.
Yeah, from the non-oil perspective,
okay.
yes.
Well, yes, largely tax,
Okay.
largely from the tax segment. But I would say that it's in terms of revenue target and percentages, I think that it's aligned with what the expectations were. It could be better. It could be better. So it's not something that I would dwell on in terms of like the improvements. Like it could be better.
Yeah, the World Bank actually estimates that Nigeria's 2021, this is like 2 years ago now, was amongst the 5 lowest globally at about 7% of GDP.
Yes.
Wow. For an economy of 200 million people. So we know that a lot of reforms obviously are ongoing, tax, fiscal reforms, trying to get some more synergy between monetary and fiscal policy.
Yes.
What are in your view, what are some of the risks on the horizon that we should watch out for? And how might we manage them? So assuming that the government's plans go ahead, press ahead, what are some of those externalities or risks that you think as a country we need to keep an eye on?
Well, one that we have no control over is really the oil price market. So we don't have control over that. So shocks that would come from that. So that is one risk. I would say also just global inflation figures as well. We have seen that there's been what is the word now? A dip across specific inflation figures for specific advanced economies, and that is a positive. And we're seeing how that is helping the central banks of these economies to stay postured. But it is still elevated. It's not back to pre-pandemic levels. So that is also something that we have no control over with regards to like shocks or economic shocks, because as inflation is going up, we are dealing with an import-dependent country, which is Nigeria. So importing on the back of higher prices triggered by higher inflation. And then there's also the FX depreciation. It's just like a double whammy.
Yeah.
So I would say inflation as well. Hopefully no new or
new being the operative word.
Yes. Geopolitical risks. So these are things we don't have control over.
So globally, when I was looking at equity markets earlier, one of the things that has led to positive sentiment in the last week is slowing down of inflation in key markets. So we're seeing in North America and the Eurozone, inflation has slowed down, and it seems like inflation targeting has been fairly effective in many advanced economies. Interestingly, in Japan, we talked about the services sector in Japan earlier on the show, and they had to loosen monetary policy to kind of boost demand. Again, that's been effective. So it seems like they have stronger transmission mechanisms. And I guess maybe for the purposes of the viewers, you take an action, it may not result in an outcome. But in many of these economies, you're seeing the effect of the tools actually yield results. But somehow in many African economies, that transition mechanism is somewhat weak. So the central bank last week had talked about a new inflation targeting framework. What's your assessment broadly of how that might really impact the outcomes that the bank desires to see insofar as monetary policy is concerned?
I like what you said about the other advanced economies. Inflation, we do have demand pull and then we have cost push, right? And so it depends on the blend. And in my opinion, for advanced economies, demand pull has a bigger portion of their pie chart when I look at the two of them.
So demand is sensitive to interest rate moves.
Yes. However, in quite a number of African countries, it's more cost push because of supply side constraints, right?
Right.
And so the efforts cannot just be centered or focused on monetary policy tools. There has to be a fiscal element as well for us to see that's a significant decline that we would like to see with inflation figures. But just from a positive base effects perspective, we do expect to see inflation dip. It will still remain high. It's been an interesting year doing projections this year and analysis. One has to do scenario-based analysis.
Yes.
The standard or tradition before was just to give one projection, right? But now you have to do scenarios, and the base case shows a declining. The downturn scenario also shows.
Are you able to give any of those figures, or not yet?
Not yet.
Okay,
yes,
not yet. But hopefully by the end of the year we'll have a view coming out.
Definitely.
Yeah.
Definitely.
So, I mean, looking at all of this, it's been quite a long year for a lot of economists, from the time of the transition to the rolling out of the various policies, the kind of plugging some of the fiscal leakages, end of subsidy, trying to stabilize the exchange rate, and then looking at reforms through the various works of the ministries in key sectors, agriculture, telecoms, financial services. Which one of those, if you were kind of looking at wearing your economist hat, which one of those policies do you think have been the major driver of helping to stabilize Nigeria's economy? So, I mean, they've all not been perfect. But if you say that there was one thing we absolutely needed to have done to at least help us get some measure of stability, which moves, policy or otherwise, can be monetary, fiscal?
The thing is, so each policy, we understand why each policy had to take place, but the benefits have not materialized yet. It's too close for those benefits to have materialized, right? And so, on one hand, speaking as an economist, I could roll out the positive implementations, but on the other hand, the layman would not be able to absorb that yet, right?
Yeah, because of the timeline, it takes time.
It does take time, and it has really squeezed. Some of these policies have, had an adverse impact or effect on the normal consumer. So I think maybe you should ask me this question in the first quarter of next year. And I will give you...
That's a very interesting point, because a lot of economists have said that we will start to see some gradual recovery next year. But I'm glad you mentioned the layman, because interestingly, one of the things that the CBN governor had said in a speech at the bankers' dinner, and it's not a narrative we often hear from central bank governor, he was talking about human development indices. And I think that's a huge factor, because Nigeria for many, many years now has really lagged behind on our HDI, Human Development Indices. We know what the multilaterals are saying about this. And do you think the current direction we're in really places enough emphasis on that when you look at human development indices? Well,
I would say that it was refreshing to see the critical sectors that were mentioned in the budget, that were highlighted in the budget for expenses, education, healthcare. There's some money put aside for poverty alleviation as well. So I did find that refreshing, and it did give the sense that the administration is really focused on boosting or enhancing socio-economic impact, not just from a business perspective, but from what you just mentioned. And if these things are done properly, if the right programs, interventions that would be attached to these allocations are done properly, we would see these indices improving.
Fantastic. It's been really great talking to you, Chinwe. I wonder sometimes how you do it, but it'd be nice for you to come back on the show and give us your end of year predictions and heading into 2024. Do you have any thoughts on COP28? Is that an area of coverage that you...
Everyone needs to be plugged into that, and it's ongoing. So we're all watching keenly, and we're looking forward to the results or the outcomes or recommendations that are going to come out from that.
Yeah, indeed, and of course Nigeria obviously suffers a lot from climate change effects, and hopefully part of that $260 million that's been raised will be channeled to dealing with some of these climate change mitigation measures. Thank you so much. Great discussion. I really enjoyed that. Chinwe Egwim, Chief Economist at Coronation Merchant Bank, who has published hundreds and hundreds of economic research papers, also head of research and intelligence at Coronation Merchant Bank. Thanks for being with us today.
Thanks for having me.
Thank you. Well, That's all we have time for today on Business Week. We can, of course, continue the conversation on X. Do chat me up there if you'd like to have a discussion on any of these issues we've talked about today. Have a lovely weekend ahead. I'm Rolake Akinkugbe Filani. Stay well.